Hey, we're back and we'll be discussing SIPs as I mentioned in the previous video. Today, hopefully, we'll be embarking on stronger road towards financial literacy. Let's get on it. We'll start off with the same way. I'll do a get ready with me. At the same time, explaining things to you in very, very simple ways to understand what investments are like. This is your way to financial freedom. Okay, so we'll be starting with what an SIP is. Anyone who starts on their income earning journey, they definitely have heard of this term. So SIP stands for Systematic Investment Plan, a small way of putting aside a token of your savings or a token of your income into a savings fund. I'm going to be starting off with some sunblock. This is my Fenty Beauties and it's really easy. It's like easy to carry in my purse. So I usually get things which are, very easy to stuff in my bag. It's just, please don't forget whenever you're applying sunblock, apply on your neck comfortably. I usually, in the winters, I use like a more oil-based sunblock, and usually it has to be like a 30 or 40 SPF just for protection. So I want to break it down to you like SIP for dummies. So let's understand this. Whenever you're earning some amount of money, whether you're a freelancer, you're like a regular employee, that means you're getting some amount of income from somewhere and you want to start saving money. This is aside from all the bills that you're already covering. So that would mean that you've sorted out whatever you need for the month, and if there's any extra amount of money, is to ensure that whatever it is, it could be a small sum, it could be a large sum, whatever you're comfortable with, that portion will be set aside in this fund. You might also be thinking that, listen, I have a savings bank, I can put my money there and it'll keep collecting. But banks don't actually give you a very good interest rate, like in the sense, even if you keep storing money there, and I think within a year it's like very small sum, 3-4% possibly, depending on which bank it is and what kind of account you hold. They may offer a little higher interest, or even like zero savings account, so you may not even be earning anything, but not only saving money in the bank. And while you're used to that and you're comfortable with that, because there's no headache, it's just stashed there, I think your option of having a savings beyond that percentage is why we're here, just so that we can learn what you can do with your finances. That's just the basic core. Okay, so we'll be doing some concealer. My go-to again, I've seen it in enough videos by now that you have to let your concealer just pick up on the color and darken as is, still not cakey when you're mixing around the ingredient on your face. So just to break it down to you, it's just an area where you're putting in your money regularly in small intervals. But here what an SIP is, that it's taking your money and putting it in stocks. So for you, it's like a really simple process. Instead of you doing it manually in one stock each, this fund is just got a portfolio of stocks, and they put in the money there and they wait for that money to start building up. In the sense, it's just the same way, like you have your stocks and you're waiting for its value to keep going up. Obviously you have to keep tracking it there. With SIP, they're tracking it for you. The concept is the same. It's just that somebody is doing it for you, and you're not paying that individual who is managing your amount of money specifically. But it's just that because you're putting in that fund, so they're running that fund. So that fund can be subscribed to by like a million people. This is the basic crux of what an SIP is. This time I'd mentioned we were discussing brands like Trent and Raymond. And if these were the brands which are part of the SIP you have put in your money in, now let's say Trent starts doing really well and it's picking up on its value, then you know that your stock value is going up, and along with that your SIP is growing as well. So the percentage could be like, let's say, I think in 1 year it had gone up to like a good 20% or whatever, and which just goes to speak that, like, as compared to your 2 to 4% that you earn in a bank, here it's going up by that much. Just for you to understand what the potential is of an SIP. Please don't obviously go by like it is always going to hit at 20%. It just works like the market, like with any stock company. If the stock is part of the portfolio, so it'll go up and down. It could go really high. Some of them may not do well, but it's a bunch of stocks, right? So it's not just one individual stock. That is what an SIP is. Your SIP keeps collecting, and that fund becomes a mutual fund. That's what it's addressed as. There are many kinds of mutual funds, of course. There are many versions. You don't have to have a monthly deposit. You can also have a quarterly deposit. You can also have a lump sum deposit. So there are professionals handling that portfolio. So to do the kajal, it's nice black. It's not super dark, but it's also like it's good for the daytime and it doesn't smudge. That's the best thing. So your SIP is managed by whichever fund you're putting in your money. Let's say there are a bunch of people who are already putting in the money. So it's you, five of your friends, they're putting in 500 rupees every month in a fund. Now, this fund is being run by some professionals who are running the stock market, who are managing your stock portfolio, and they're looking at it on a regular basis. And they're saying that, okay, it's doing well. These are the stocks that are doing well. I feel like the money I've collected from these five people, I've studied the data of this company. I'm collected that much money. I will put it in these stocks. These are trustworthy individuals and these are trustworthy companies. Let's say, for example, that they have decided that the fund is going to invest in jewelry brands. For example, there's PC Jewelers, you must have heard of that. There's PN Gutgill, you must have seen ads on Geo if you've seen any of the shows or movies. Kalyan Jewelers, every ad of like all the weddings, Virat Kohli, Anushka, who else got married? Kiara and Sid. And let's say this fund is putting in the money in jewelry. They're saying fund managers have decided that we're going to put in these three companies. They see that it's doing well. They're beginning to see that Kalyan Jewelers are not doing all that well. So I bought 10 stocks of that company. I'm going to sell off five. I'm going to keep five. And I'm going to pick up another five from another company. Let's say I'll pick it up from Titan. They have a very, very solid jewelry segment. And they've been running for a very long time. It's called Tanishq. I'm sure you guys have heard of it. Household name, seen in stores everywhere. So it's a very solid brand that the managers have decided to put in the money in. So they can see that, okay, you know what, this brand is doing well. In time, maybe they'll be like, let me get some more stocks of Titan itself. All the five people are putting money every month anyway. So that fund is growing. So they're able to put in more money in the stocks. They're able to retain those stocks as well. So they're like, okay, you know what, Kalyan's not doing all that well. Let me sell two more stocks. I still have three. Let me get, like three of Senko. Again, it doesn't mean that they only are allowed to be getting certain number of stocks. They can get as many as they want, as they see fit. Like if they feel like this is how it's going to do, if they figure out some kind of projection where the money there is going to go well, and the stock companies are doing well, that means the fund will do well. So now the concept of mutual fund is this. I'm also on my next step. I'm using ELF. It's brown color eyeliner, so it's the usual black. And for daytime, I figured, why not? I'm just gonna put some on. Usually, you're supposed to put a primer on your lids before applying any kind of makeup. But as I've mentioned previously, my skin's kind of like on the path of healing. It's not doing all that well, so I don't want to put too much product everywhere. I just want to put like wherever there's bare minimum. I don't want to. So I've broken it down for you, like in general, how a mutual fund would work. There's just like equity funds, there are debt funds, and then there are hybrid, which is like a mix of equity and debt funds and any other instruments which are there in the financial world. Please don't get confused, and it's just to understand what under an umbrella, like what the funds are. So okay, first off, so this part is the tricky part. Yeah, so the equity funds are the ones where you bought stocks, like you have bought your stocks previously. um like let's say you bought like a Nika stock, or you bought an Eternal Zomato stock. These are like getting a share of the company. These are getting a share of their equity. So if it's a big company, now let's say if it's a, you know, TCS, like Tata Consultancy Service, large capital, like, because that means it's a company, because you know it needs a lot of capital. It's an old company, it's got like several employees. That's a large cap company. A mid cap company is like your Nika, your Eternal, Zomato, because they don't have several employees. And it's the company is obviously running on bigger numbers. And now, as you read more and more, the company has way more capex pumped into the company. So that's a mid cap company, but it's, I would say it's like en route large cap. A small cap in the same equity scheme, a small cap company is way smaller. Small marketing firms or small cap companies, they don't need too much capex, they're not several employees, huge amount of money. Then there's also a flexi cap, which just means it's again like a mix of large cap, mid cap, small cap. So large cap fund would mean that this equity fund, this mutual fund, runs on the equity of large cap companies, only puts in money in the biggest of big companies. So like an Indian Oil, it would put money in like TCS, it would put money in Reliance. These are the large cap companies. Okay, I've just ordered this Swiss Beauty lip liner. It was for 66 bucks. So I was just like, spent like thousands getting this. What's the fuss about that? And it was so highly rated, so I was like, I gotta try it. Such a nice. I love a new tip. Mid cap would be like all the companies the fund is putting in money in is mid cap, so maybe like a Zomato, maybe a Nika, maybe a Swiggy. So the color came out pretty neat. It's best part is pointed, so it's does a good job on the tougher parts. There are debt funds where the company's bonds, or if there are gold bonds, or if they're government bonds, government or companies putting in heavy money on a certain property or certain item. So it would be like foreign exchange could be one bond, it could gold could be a bond, silver could be like, these are materials in which they put in the money, and that's their mutual fund, like that's their. Then your other one's a hybrid, so it's a mixed bag of equity and debt funds. Reason why they have a hybrid fund, because equity just means it's higher risk, and I don't want to scare anyone, go like oh my god, you can lose all your money, and then debt funds, you can't lose all your money. It's no such thing. It's just risk also means returns are better. Debt just means that your returns are safer, in the sense that it's a slower, not like insanely high potential of and boom into like the percentages of savings that you would want in that kind of speed or in that kind of term. So that's why people go for hybrid. Oh, these tiny versions of lipsticks, they're my favorite because they can go in every bag. Once again, anything pocket friendly, travel friendly. This is the Icon Huda Beauty, one of her popular colors. Daytime, almost evening, going into that kind of zone. Yeah, I want to give you some examples of the companies that are the mutual funds of equity brands. So if you start an SIP and you're like, this is the fund which I have picked up, and that's a bit of research you can do, is that they'll tell you what are the companies they put in their money currently in, that you can track even when you start your SIP. So let's say you're putting in 500 every month in this fund, so they'll keep like informing you also via email that this is the update of the month, and you these are the companies in which they have invested in. And I don't put too much. This is only so that I can always hits the teeth. So I put my finger and I remove it. So anything that is around extra excess gets stuck on the finger. Of course, this is a really good matte, fast drying thing, so that it doesn't transfer to anything else. I've just chosen some companies in which you can start your SIP with, and you can see it yourself also when you say direct or you're on Grow or any of these brokerage firms where you can start your SIP. So there you can choose what are the top SIPs. They'll also recommend, and you can look it up yourself. I'm going on the basis of 3-year returns. There are also 10-year returns, and then there are 1-year returns usually. And that option you have there, you can see that every fund how much has it been able to give in the last 3 years, last 10 years, last 1 year, and projecting what will be the returns in the next 3 years, 10 years, 1 year. So based on this, I looked up equity large cap, which is ICICI Prudential Bharat 22 FQF. Now, why I've chosen this? Because their return is 27.5 in 3 years. That's like massive. That's really, really good. And this is what they projected. There are chances when the stocks in that fund has put in the money for 3 years, could have done really well. Let's say some of the companies would have done like 5x, then this percentage would be much, much larger. The reason why I'm not talking about like, oh yeah, if the company didn't do well, then the projection would be much lower, because that's a duty of the fund managers. If you're putting in money there, so they see that some company is not doing well, they tend to sell off those stocks, remove those companies from their portfolio, and they proceed with companies which they think are potentially better. So I would say that this is one of the lower amounts. The only time when it can go really bad is like when the stock market has really gone bad. There's been a crash in the economy, elections which have like deterred stock market at that time. Maybe recession has happened, a 2008 situation has repeated. Hi. Okay, so I just discovered that all the video I shot, the mic had stopped working. So I'm going to go through all of that again, but I'll go through it quick so you don't have to waste too much time on that. I go through, like, I research all of them and I look up whichever charges at the time of you withdrawing the fund, and you're like, I've saved so much right now, I need to remove some amount of money right now, or I want to remove all of it right now for whatever reason. And at that time when you're withdrawing, what are the charges that go through, what are the taxes, all of this implied. And after that I have just selected some of the funds. For the time being, I'm just selecting the items which are, sorry, just want to show you my earrings. I think I've shown them before, but I didn't get to wear them. They were hurting my ears. Today I will wear them. When you're starting off, this is what I want you to focus on. Like, I'm not saying don't think about the pointers which matter at the time of withdrawing, because that stuff matters too, and that's also important while choosing, which is why I've chosen these, because wherever I felt that the taxes were lower, the charges were lower while withdrawing, and also got you decent amount of benefit in the sense that your interest that you have collected over the years of saving that fund, on the basis of that I have chosen these. Yeah, Flexi Cap is the next one I'm going to recommend. I think one of the strongest ones most people like. One I'm recommending today is HDFC Flexi Cap. Its return rate is 23.4%, and the other one I'm recommending is Invesco India Focused, 23.8%. Now these are very high numbers and the return rate is really good. So also they're very trustworthy companies. So I feel like most of the ones which are run by a bank or a fund which has been popular for some time, I'm recommending those. You will definitely have heard another one which I will speak of right now, just for like, it's called Parag Parikh Flexi Fund. That's one of the most popular flexi cap, because they've just managed to put in a lot of money in the stocks, and they also keep aside the money in cash form as well, which helps the fund stay afloat also, and helps the people who have invested in that fund and been saving in that fund also. That's it. Most of the information on that you can look up online. And so yeah, flexi cap is just good because it's got a good bag of, like, it's a mixed range of large cap as well as like mid cap and small cap. So I definitely invest in flexi cap. It's a good fund for me as well. And your good mid cap company 3-year return is HDFC mid cap again, 25.2, very good. The other one is Motilal Oswal mid cap, which is 25.1. Both are good ones to go by. I feel like these are brands which have been reliable over time. A lot of people, when you ask them, they would mention some of these names as well. So while you're checking out all of these, right, you can also see, you can put in the portion of money you want to put aside every month. Maybe I have one SIP for like a regular income which I can save every month or every quarter. And also sometimes when I get some money, maybe your grandmom gave you some extra allowance money or whatever, any gifts that you accumulated over your birthday, or maybe some festival, or the Tyohari or whatever you get, you have that money set aside, or maybe you got a bonus from office, that lump sum you want to put in a fund, and that also you can do. So you have that option to choose even in that okay, I put in a lump sum, let's say you put in a lump sum of 10,000 or 1,000 or 50,000 or whatever it is, and you can see how much it can be collected over time in the fund. So it's not like you have to put in regular money in that fund, but that amount that you put in, and you can keep adding to that amount also whenever it is that you have. So it'll collect on the basis of that. So the period of time in which the money is stored in that fund, that is how the percentage is calculated. So that's like a mini version of savings bank, but again, because you're putting in a fund there, the return rate is so much higher. That also you can check. Okay, a small cap company, Bandhan Small Cap, 29.3%, one of the highest like 3-year return rates that I've read and I've also discovered. The good thing with small cap companies, and I think that's a good fund to put in your money, is because companies, you're not aware of many small cap companies, but the beauty of these small caps are like, obviously the fund managers know how to run your assets, right? Like they know how to run your money, they know how to assess these companies, so they know how to read them, they know when to pull back in time when they are not, when they start tanking or they're dipping, and then the stock values are not doing well. So they are aware of that, and while you may not be, you may put in money in a small cap company as well on the stock exchange, but you may not have that much access to information. They have so much more. They are bred in reading this kind of stuff, so they gauge the market better, which is why you're putting your money on a risky area, because it's a small cap company, it runs on, let's say, 50 crores, 100 crores or whatever, and it tries to do well and hopes for profits to do. They skyrocket and their profits do really well, even for a small size company. Chances are they don't do well also. Maybe they start tanking, because a small cap to become a big company is really hard. To start doing well really fast is really hard. So now this is something they're monitoring. They're like, oh, it's not doing well, let me remove some stocks from this, or let me remove some of these companies from the fund, and I'll put in money in another small cap company. Now they're doing the risk assessment constantly. Personally also you can do. These are established companies which you're using, but you may not be aware of small cap companies. So I feel like putting in money in a small cap fund is easier, because the risk is high, but taking the chance, right? As opposed to you discovering and you're researching. You are free to do that, but it's recommended that you get this much time anyway, in your day or in your week, already putting in the effort and studying these other companies that you've already spent money on. Intensive amount of research and effort it'll require from you. I feel like it's just better to put in the money in these funds. Then you have hybrid funds also. That's why I recommend ICICI Prudential Equity Debt Fund. It's 20.3 return, because they have like a mix of debt and equity. So it's fine that you put in money in a fund where trying to see how you channelized your money in this area, because most of the stocks are equities, so you already know how it works, you know what the returns are like. This is 20.3 is a good standard, it's pretty good. I just feel like for a mixed bag it just makes sense. I'm just going to tell you one. You are obviously free to check out many more if you want. Given you examples of these funds, I'm just going to get ready. I'm going to talk a little more and explain to you what the next step is. Once you've identified your SIP that you want to start, which fund is in which you want to put in your money, just want to be able to explain to you what the benefits are, and I just want to talk about the risk instead. I'll have my sparkly shoes to do the job for me, but this would be the whole look, and discussing the benefits. One of the good things about starting an SIP is that you have professionals managing your portfolio, multiple people putting in their money, so which means you're not dealing in like few hundreds, thousands, you're dealing in crores worth of money of the entire country. The fund is being run by these established professionals, so who are already literate in this area. They know how to manage these funds. I feel like that's one of the safest things, because most people are probably more aware of the market than you are, at least at the beginning. So another positive thing about this is that you can diversify, right? Like you have options of many kinds of funds. While, like, let's say for me, I'm interested in quick commerce, e-commerce, fashion, textiles, beauty. This is an area which I'm comfortable with, so I know. Now there may be other areas in which I'm totally unaware and totally which is where these funds come in. Then I'm putting in my money. Let's say hospitals do really well, and they're obviously, at today's day and age, they are literally profit-making companies. Anyone who wants to put in their money, anyone who's been to the hospital knows that they take so much money, so they're obviously running at a profit. Funds which are investing in stock companies of Apollo, Max, Fortis, these companies are booming. Their numbers are high, their stock values are high, their companies are doing pretty well. So these mutual funds in which you will be investing in, they will be running and monitoring these companies. So if the portfolio engages any of these kind of hospital brands or hospital companies, at least I know they're putting their money, they know how to run it, and I know they're profit making. Hospitals just end up doing well forever, I felt like it's a safe bet to put in the money. Then there are public sector banks in which people put in their money also, like an SBI and things like that. Also private banks, so there's like ICICI, HDFC. These all have stocks as well online. So that's how you diversify, right? So one mutual fund could be running on like these banks where they have portfolio includes these banks as well. Some insurance companies also do well. They are off the banks only. So there's LIC, there's Bajaj Housing Finance, which is also insurance, and they all have stocks online. Any of the funds which you have these companies in their stock portfolio, that's great because you know they're doing well. You've heard, imagine if it's not even an area of interest, we would have already heard. This itself is good indicator that this company could take your fund in a good direction. So this is why the return rates are higher. Elements help you kind of decide, and I feel like a diversified portfolio helps your chances of funds doing better. So whatever 500 every month and that money is going into a stock portfolio is doing well, then my money which I'm saving via that fund is doing well for me. The really good pointer for me, I feel like with mutual funds as opposed to fixed deposits, so you have the option to withdraw anytime. You're not stuck with for a certain period. There's no term period you have to complete. You can withdraw anytime you have the need. You can also roll it up just to look fun, I feel like, but I have a skin issue, so but yeah, this is how the sunglasses look. Withdrawal option is there. I do recommend that when you start a fund, try to stretch it out for like over a year, because any fund, any amount of money that you're putting in, because the government has started taxing you, so you're charged 20% for anything less than a year. Anything above a year, you're charged 12.5 whenever you're withdrawing. So it's on the amount you're withdrawing. So it's better to withdraw after a year. And please understand that the concept here means 500 every month. So what I've started with today becomes 1 year next year. As every month proceeds, like I've started in November next year, my November's amount of money taxed on that 1 year amount. But whatever I've invested in December and I still withdraw that amount in next year November, it is considered 11 months. Point being that only withdraw when you absolutely need to, because there will be some funds which you have collected over time and then you can 12.5% if it's within a year. But say you've collected for 4-5 years and you have enough money in that amount, you want to withdraw 2-3 years worth of money, you're okay because it's been 5 years and 3 years or 2 years amount is less taxable. And I mean, I hope you get the gist. So other flexible thing about mutual fund is that you can stall it also in the middle. I think you're allowed 3 times to stall any of your SIPs. I had mentioned previously the stock market wasn't doing well. It was in red for a little bit, and at that time I decided to stall my SIP for about 1 to 3 months or something. You can restart it again because you see that it could be anything. You lack of funds, it could be some market decision or whatever it is. Instead of putting in money where it's not giving you a good return as it is currently based on the current market situation, at that time anyway you shouldn't withdraw. So you should just leave the amount of money there only, stall the SIP, and then you can restart it. So this I think you can do about 2 to 3 times, or I don't know, depending on whichever fund. If you have the option to do more times, then that's great. Also, whenever you're withdrawing, I would recommend please don't withdraw the whole sum. I mean, obviously keep it for your heyday. If you can keep it for 10 years, I haven't started investing so long that I can say I finished 10 years anyway. But I'm saying that in general, if you have that option, if you are privileged enough to not have to need that saved amount of money immediately, then that's great. Keep it for as long as possible, because your whole percentage of return will be applicable on that entire fund, whatever amount of money you put in. And that will be a huge amount for you to be able to withdraw. And say you withdraw even after 3 years, which money? They want to put in other funds, or they just need the money at that time, they're going on a holiday, whatever it is. You can withdraw the amount and you can still, the fund will still continue. That every month will still take that money. So that is also there. So you don't have to worry that, hey, like I like the portfolio, once I've withdrawn, all that is gone. You have the chance to, obviously you can restart from any other fund as well, but it continues. These are few aspects in which the mutual funds, I think, work in most people's favor, earning people's favor, and the capacity that's possible to them. Some funds obviously have limitations in the sense that maybe the starting fund may not be 500, maybe they'll have a starting of 1000. Some funds are okay starting with 100 a month. So see whatever is workable for you, because all of this is available online. You go on Grow, you go on ICICI Direct, you go on Zerodha, you go on Dhan. There are many platforms, but you just have to see which one has brokerages fees and which one charges what. Some charge on an annual basis, some charge as per the individual mutual fund you start, some just start when you're withdrawing. Okay, the final part is discussing the risks. So risk is just this, that if the market tanks, it affects your portfolio. It affects the fund that you have managed to save all these years. Because at that time you'll be withdrawing, it may not be worth that much. So last year was one of the really glorious years of the stock market in India, and this year was one of the not so great years for people to withdraw in the middle of the year. It's not like it doesn't climb back up, it starts to climb back up, so that when it goes in red for a little long period, that's called correction in the market. So if I want to withdraw some amount of money, the return rate was so low because whatever I'd invested, almost a similar amount for one of the funds. It just felt like, my money was just going there, but I wasn't even able to withdraw % of more of what I had put in the money. And there was one fund with value had dropped so much that even the amount of money I had invested, that itself couldn't be saved. I mean, let's say I put in 100 rupees every month, and it became 1200 in 1 year, and when I wanted to withdraw it, it wasn't even worth 1200. It had dropped. It had gone below 1200. So the value of my money being put in because of the stocks, it had dropped so much that I was not able to redeem them. And I didn't feel like, obviously, because I was like, why would I redeem them at a negative? It would be a loss for me. I'd rather, redeem them at a time when it's positive. If I invested 1200, I should at least get 1201 rupees back. Minimum, right? Obviously, on a good heyday, it's been 3 years, 5 years, you can withdraw your 1200 can become 3600, your 1200 can become 12,000 also. That's just how the stock market goes. That's the biggest risk, and that one should always be aware of, which is why a lot of parents and obviously anyone with any kind of experience obviously will have this one very strong factor to oppose you from choosing mutual funds or putting money in the stock market, because the risk is always there. Even the bank, even if you're putting in the money, whatever the amount of sum, it's still 2 to 3 to 4% that you're saving. So like you are taking the chance of not doing the 20% return. So I would say give it a shot, save little bit. Once you start getting confidence, you feel like I'm good at reading stocks myself and things like that, and I'm willing to put in more money, and I'm seeing good benefits of it, the results are good, that my income itself is able to sustain my general life, and also the savings I'm putting aside is also not harming me, that also my savings are untouched right now, it's okay. That don't use all your income and put it there because you're like, I need the money now and I can't withdraw because the market is tanked, it's not worth that much. Please don't do that. Definitely a dangerous option. But the other risks are not so much risk, but more like the charges, the fees, the tax. Last year the government changed the tax system again, so earlier you were not charged on your long term like withdrawals or whatever. You are charged on a long term also. So earlier it was just short term, it was I think nominal fee, very small percentage. Now it's gone to 20%. So I mean, these things will happen, that's a risk. You can't control what the government decides today, tomorrow, whatever. But the best thing to do is first just start off and check it out for a few months and see how it is. So you will get an idea of how it's working. The more you talk to your friends, your seniors, your family members who are interested in this area, they'll also give you an idea like, this fund is doing really well, put in your money, see the benefits even within 1 year, things like that. I'm not saying that listen to everybody, but I'm saying that an informed decision is really good. I would always advise checking out for yourself, and it's worth it because while you're on this journey is how literate you become, and nothing like experiencing it for yourself. So this is for people who may not have as much time to invest in if they're not doing stocks themselves. But it's also good for people who are doing stocks because there are always going to be areas in which you may not have full autonomy in terms of information. You can put in money in a shipping yard, any kind of shipping company also, unless you have a billionaire friend who can give you access to information about that. But till then, those are big stocks, those are big companies, usually they're pricey also, and even if they're not pricey, but it's just an area you have no idea about, but you also know they do well. You may not have knowledge in all the areas, so that's why these funds come in. You don't have to start a mutual fund in every area. You don't have to diversify so massively. You don't need like 10-15 mutual funds. I think select a few if you can afford it. Put a little money in some of them. Your best bet is to start with one fund. You'll see that it's picking up. Once you've worked out the discipline, then you can put aside some money every month, and you can expand that into like 2 funds, or you can increase the money on that single fund. And I enjoy seeing that the savings is growing. That's the most beautiful part, I feel like, which people seem to ignore mainly, but that's also the addictive part, because you see that fund growing, you're like, I want to do more, I wanted to grow more. That's when you know, I'm not ever saying that stop shopping or stop traveling or stop eating out, like loved ones would say, na, that you'd rather put in the money in an SIP or whatever. This is what they mean, because spare those pricey shades, that expensive bag maybe. I'm also one of those who are on the camp of, you save that money so you can buy that bag, you save that money so you can take that holiday. That's up to you. Do whatever you can and whatever you want to. Savings is a good way towards financial freedom. So please, like, enjoy the journey more than anything else. I hope this was a useful round, and we'll discuss more very soon. Thanks so much. I'm so glad that this could help anyone out there. See you very soon. We'll be discussing more next. Okay, so I don't know if you can see my whole look, but this is my Henley t-shirt. I love a Henley t-shirt. I've also picked up these really fun white jeans from Zara, and I just love that they're like pleated from somewhere and then they're like fully dyed. So I picked up shades which I'm going to be wearing. So these are sparklies, and anytime I'm not wearing anything which is you know, blingy on my neck or my ears, I definitely wear shades. I feel like it just adds to the look so much, and you know, especially during like winter wear, like Christmassy, after Diwali is a great time, because it just spruces up the look, makes you feel festive, and also concert season starting. So these are the ideal shades for that, right? Like, I love it. So shiny. So it'll also be matching the shoes I'll be wearing.